So we'll start the session here. So it's again a very special day for us because this time we've invited Naveen. Naveen is the fund manager and the founder of ITU's Capital and has been into existence since 2013 onwards. In fact, he's the only fund manager in India who has worked with large organizations like Lehman Brothers and also saw that the debacle of Lehman Brothers happening. So that gave him more wisdom to manage risk more effectively while managing the poor client's portfolio. So Naveen brings about almost more than 17 years of experience on the table when it comes to fund management. In fact, he won many awards as the best fund manager while working with large organizations in abroad, and he's got presence in India and US both as far as PMS in India is concerned. And he's did his engineering from Bangalore. I think that was Bits Pilani, and also did his MBA from IIM Bangalore before starting up this career in the fund management. So I have been personally observing and monitoring the performance of the scheme, and I must say that Naveen is really able to manage both the downside risk very well, at the same time able to participate in the equity markets before time and is ahead of others in terms of delivering alpha in the strategy. So today what we'll do is we'll spend some time, understand more from him that how is he managing funds, and then maybe we'll open the forum for question and answer. So all those who have questions, please type in your questions in Q&A box or maybe in the chat box, and then I'll take the question and ask these questions to Naveen on your behalf. So firstly, Naveen, thank you so much for accepting our request, joining the call. Welcome on the board of Ask the Expert show.
No, thanks a lot, Vikas. I sincerely appreciate the kind introduction as well as you having me over on this. And I thank everyone for joining in and listening to the webinar.
Thank you. So, at the AIF and PMS Experts India, we keep organizing these knowledge-based sessions, and whole idea is to introduce portfolio managers, upcoming portfolio managers, I would say, like you, and make people understand that how do you manage funds essentially, how do you select these businesses or different businesses, how do you kind of look at industry, where do you see economy going forward. So whole idea is to read your mind, since you bring about almost close to 17 years of experience on the table, and you have had exposure of working with large organization earlier in your career. Like I think you've also worked with Hutchin Hill, and you were awarded there as the best fund manager, and you managed about more than $4.5 billion of assets over there in the fund, which is pretty sizable. So today the idea is to learn more from you that how has been your experience so far in last 17 years managing money for India from abroad, so, and both now coming back to India and then managing it. So over to you. Thank you so much.
Sure, Vikas. Thanks for laying out the context. And like you said, maybe we'll keep the presentation aspect of it fairly brief. I'll quickly highlight what we do at ITIS. How does our analyst team work together from a philosophy perspective around the single strategy that we manage, because we only run one strategy. It's a multi-cap focused, growth-oriented strategy that we run at ITIS. And since day one, back in 2017, the aim was very clear. We wanted to run only one strategy because all our money, as both the promoters as well as employees, is in the same strategy. So for us, the concept of skin in the game was extremely important right from day one. And not a single pie of that has changed over the last 5 years. Right. So with that as the context, I'm just going to share my screen, Vikas. If you could be kind enough to let me know if you can see this.
Sure.
Then we can start.
Yeah, very much.
Okay, perfect. So I think the core focus for us at ITIS is to basically look at companies that can show growth, right? Because we are growth investors by our very definition. But the beauty about our country is growth can come about in multiple forms. Growth can come from top line, can come from bottom line, It can get manipulated along the P&L or the balance sheet. So what do you really trust as an analyst? And also, the important thing to understand is just because you got growth, all of that is historical in nature. How do we as analysts look ahead and talk about where is the incremental returns going to come from? So I just want to put together that puzzle around how we think about risk, and then maybe have a more of an interactive session and take it from there. So, because like you rightly spoke about, you've already given the background. ITIS was set up back in Jan 2017. And from a disclaimers perspective, any companies, any businesses, any sectors that we discuss, there could always be a potential conflict because of the fact that ITIS could have any of these as a portfolio company. So it's not a recommendation. It is more of a context around how we think about risk rather than saying this is something that anyone should buy or anyone should sell. So, like I said, our objective has been fairly straightforward from day one. It's always been to run a single strategy multi-cap fund with a focus on growth. You will always find a concentrated portfolio of ITIS, not more than 20 companies across market caps. We don't believe in the concept of buy, hold, and forget. So you will not find any single analyst at ITIS come and tell you this is a great business, hold it for the next 10 years, right? For us, risk management has always been a keen aspect of managing money at ITIS, and we don't believe in model portfolios. So what that means is every portfolio is bespoke, and we will take time to construct it. So you may find a significant amount of cash and discipline involved in terms of how we buy the businesses that we buy. Just because money is given to us doesn't mean that we have to deploy it tomorrow. So if I was to cover our investment strategy in three simple lines, right? This slide pretty much covers the genesis of how we think about risk. I spoke to you about growth, right? And growth, fortunately or unfortunately, even in the global context, can be manipulated. For us, the holy grail of growth comes from cash flows. Now, why do I care about cash flows as an analyst? Is because end of the day, if I am a promoter or the management of an organization who's planning for my future growth, there are three ways I can think about my future growth. I can think about my growth from internal accruals that I generate today, which effectively is cash flows. I can think about my future growth by borrowing, which is effectively debt, or I can think about my future growth through diluting equity, which is basically diluting us as minority shareholders. For us as investors, cash flows effectively mean 2 and 3, which is debt and equity, doesn't get used in a significant way because both of this can deteriorate future returns. So, end of the day, when we look at generation of cash flows, it's effectively saying the balance sheet is managed well and the management is actually focused on converting whatever it reports in the form of earnings into cash flows, which it can reinvest for the future. Now, just because you have cash flows, it doesn't mean that you can buy a business because cash flows mean that you have something healthy today. Unless and until you can reinvest that cash flows into a core business for tomorrow's growth, it's of no use to me as a minority shareholder. So, what we look at measuring is how do I generate incremental returns on capital? So, if I was to explain this from a real estate analogy, right? You buy a piece of land or you buy a piece of commercial real estate. It's gone up 3 times in the last 10 years. So, you're all very happy, right? So, that means your cash flows has increased if you monetize it. But unless and until I can reinvest this monetized value into my next asset for future growth, it means nothing to me. So a business is something very, very similar. What I care about is a return on incremental capital, which is where I look for good managements and good quality promoters around where they invest. Some promoters look at unrelated businesses for expansion. They look at M&A as their core way of expanding growth. Generally we are skeptical about such businesses because M&A as a way of growing strategically is a lot harder to implement. Very few businesses do that successfully. The odds are against you. So the bar for such businesses entering our portfolio will always be high. The last and the most important part is we don't want to be overpaying to own such businesses. Now, what does this mean? Right? So, for us, valuation always is a range of numbers. As we are looking into the future, we always come out with a range of metrics from a valuation perspective around what could the business be worth in a bear case scenario and what could the business be worth in a bull case scenario. We as a risk manager want to ensure that the downside is protected if things go wrong. That is what valuation means to us. Many investors come to us and say this is at a multiple of 100 or a 50 or a 40. That doesn't mean much to us unless and until A, you understand the business, B, you understand the range of outcomes that the business can go through over the next 4, 5, 6 years, and then come out with position sizing your bet. Right? So that's what not overpaying means to us. And finally, risk management is effectively saying that just because you like a business today doesn't mean that you will like it tomorrow, because managements can change, competitive intensity can change, growth can actually have headwinds. All of this effectively means that you need to say any business you own, you have an opportunity cost around owning such businesses. So, do you still want to be owning them at the current valuation? Is a question that we as analysts constantly ask ourselves. So, at its crux, this is our strategy that we follow at ITUS. Now, at a portfolio level, what does this mean? Because as a concept, while one can look at this, the important understanding is how has our portfolio evolved in the last 5 years? Because, like you rightly mentioned, because one of the things that you were going to talk about is the markets and what is the view on the markets. How do you think about portfolio construction, considering all the global uncertainties that you are going through, right? While we have views on that, what gives us comfort is the fact that the quality of our portfolio has gone up significantly in the last 2 years. What do I mean by that? The pricing power of our businesses has increased materially in the last 2 years, primarily because these businesses have expanded without debt, these businesses have expanded on internal accruals, and these businesses have expanded by taking out market share from competition, along with the tailwinds that they have had. How do we say that, right? So, for a business, the pricing power effectively you can think of it as from a core operating profit margin perspective. And the incremental capital, you can think of it rather than ROIC for a simplistic way, an ROC. So when I tell investors, and you spoke about our performance, Vikas, where you said we've reasonably beaten the Nifty by almost 8% in the last 5 years, it's predominantly come through because our ROIC has almost been 10% excess over Nifty's ROIC. And our margins have almost been 13 to 14% consistently over Nifty's portfolio. So when you run such portfolios over a 3 to 5 year cycle, you will translate this return on capital into your IRR as minority shareholders. So there's nothing more than that, right? So if you were to look at the strength of any of your portfolios you're constructing, the simple way to look at it is across cycles, what is the margin profile of your portfolio? And across cycles, what is the incremental capital your portfolios are reinvesting the cash flows in? So this is what I wanted to leave behind as we now open up the floor to questions and then talk slightly more on the micro side. So because I'm going to stop the presentation here,
Sure.
more of an overview, and
Yeah.
then make it more interactive.
So you can stop sharing that. Yeah, yeah. Okay, thank you. All right. Yeah, so first question comes from my end. This is my observation, so I just wanted to check with you. So we saw that during the downturn, when the COVID happened, I saw that your portfolio was doing very well. It protected the downside well. And when it was coming up, it came up very well. So how do you manage to do so?
So I think if you look back on the portfolio style, right? I mean, obviously COVID was a reason for the sell-off, but I mean indices fell anywhere between uh, 30 to 37% over the 3 months from Jan to March 2020, right? And we were already overweight pharma well before COVID, right? We had significant exposure in API manufacturing. We had significant exposure in CRMO and CRAMS and CDMO. Now, we did not have exposure because we thought COVID would come. We had exposure because these businesses were generating cash flows. They were growing consistently on the back of internal accruals, and their return on capital was north of 20%. Right? So when COVID hit, right, these businesses effectively gave us a significant cushion on the downside. So we did have banks. We owned HDFC Bank, and in March 2020, if you remember, because that was the time when Aditya Puri sold his entire stake as well, right? So we took a lot of flack because we increased our exposure in HDFC Bank at that point of time, right? So it was extremely uncomfortable for people because the economy was coming to a stall, not just in India but globally, right? You were talking about NBFCs who had collection ratios of 95%, dropping it down to 32% in a single month. But when we went and did the due diligence on the ground, spoke to the bankers, spoke to the DSA agents, right? The loan book, you wanted to always buy the lender with the best quality loan book. And that is why HDFC Bank was important for us. Along with that, when Shashi took over, there was a lot of both ex-employees as well as, I'm not talking about employees today, I'm talking about employees who've been in the bank since 95, when they built out the retail franchise, right? Because Shashi has been in the franchise for a very, very long time. People have seen Shashi in the franchise around how he's led the company. And he's always been a process oriented person. And for a bank, I can tell you one thing, having seen a bankruptcy live, a process and risk management is everything. So once we got comfortable around the person and some of the loan book delinquencies on the ground, along with the stressed scenario of what could go wrong, HDFC Bank at around 850 rupees, which is where we aggressively scaled up the position, reflected the risk that the market was already pricing in. We didn't think there was too much of downside from there. So for us, it's always a question of risk reward at any point of time. So to go back to your question, how did we protect value? I think one part of the portfolio was protected because of the kind of businesses we owned in pharma. And on the upside, we actually had a reasonable upside pickup because we owned exchanges back then. We had a significant exposure in IT bar tech, which did well for us, and pharma cushioned us on the downside. So that is with the benefit of hindsight, but the core philosophy of it never changed, right? So it's the process that drives the outcome. That's how we think about risk.
Okay, the next question is, so, which are the two, three sectors you think, according to you, should do well going ahead in next 3 to 5 year perspective, Naveen?
So, because for us, it's always bottom up, right? Rather than top down. Having said that, right, we also have sectoral exposure because if I own Infosys, that means I am overweight tech or IT, right? So, I am going to translate my bottom up view into sectors rather than my top down view into companies. That's not how we think. So, just as a caveat. So, if you look at IT earnings, Vikas, and you've got both your majors like your TCS and Infosys and HCL Tech out of the way, and your mid caps like your Elixir and your L&T Technology Services and LTI coming out with earnings. The consistent theme is margin compression, right? Very robust order book. Some of the total order volume that these businesses are getting is unheard of in the last 20 years of their existence, but margin compression. Now, when you have reasonably good valuations baked into this, you are going to see some amount of volatility on the downside, which is what you're seeing on IT. And I continue to believe this is a structural theme, right? So I would always urge investors, once you have conviction in your process and the businesses that you like, volatility should be good for you rather than bad for you. So I continue to maintain that IT bar tech is a structural theme. You could have volatility over the next 1 or 2 quarters, but use that as your friend rather than reacting to it on the downside.
Sure.
Second,
Yeah.
second thing that you asked me two themes, so I'm going to go into two themes. Second theme is I continue to maintain pharma with the domestic API manufacturing base, where the supply chain is backward integrated fully. Right. So there are three aspects that I maintain. Right. Pharma, domestic API manufacturing base, where supply chain is backward integrated. When all three come together, you have a potential possibility of this working out fairly well over the next 3 years, 3 to 5 years. So I continue to maintain that this should work well for India.
So essentially, it's IT, pharma, and to large extent, banking and financials.
No, so we are the most underweight banking and financial since the inception of the fund.
Okay.
Right? I have not been this underweight. So this is a very counter consensus view, right? If
Mhm.
you look at any mutual fund, any PMS manager, any AIF manager,
35 40% is the
they've
weightage.
all been overweight banking and financials. We have cut our exposure. We've completely exited most of our banks. We only own two private sector banks, and the weights are the lowest that it has been since inception of the fund. So I think there are better pockets of opportunity than private sector banks today.
Sure. So one of the question which comes from one of our client is, Naveen, you've discussed a lot about CAMS as a growth story for next 3 to 4 years, but don't you think that it faces threats from products like ETF, small case, and wealth desk, etc., etc.?
So I think so. Let's first discuss ETFs threats. Sorry, let's not use the word threats first. Let's first discuss ETFs and small case, then the mutual fund industry, then CAMS, and then talk about the threats. Right? See, ETFs are here to stay very clearly. Right? There is a place for passives, maybe in everyone's portfolio. I don't know, but end of the day, I keep telling investors this: passives are very boring. Okay. An investor needs to understand that if he needs to get into passives, he needs to learn to filter out the noise and say, I'm not interested in the markets anymore. Right. So if you are telling me that ETFs will take over the market, then it also means demat accounts will start shrinking. You cannot say demat accounts will keep increasing and passives will take over the market, because these are counter cyclical trends that you're talking about. I still feel passives have a role to play for many people who think I don't want to get involved in active management at all. And I think in a country like India, that may not be the right thing to do, but if it suits an investor psyche, they should do it. I don't think small case is for everyone, and I've always maintained that. I mean, you can shop for mobile phones on Amazon, right? You can shop for mobile cases on a platform, but I really don't believe 550 so-called themes, or maybe even 5,000 so-called themes you can shop for on small case, right? So I'm not. It's great in a bull market, all of this will work. And I always say this: do remember this. There was a company which was a small case equivalent in the US. In 2019, they filed for bankruptcy, right? So there is a reason why all of this happens. It works beautifully in a bull market. If it works, great. If it doesn't, I don't look at it as a threat. So I still think mutual funds are here to stay. They In India, people need to remember that getting access to a professional fund manager for retail at the cost that SEBI has given you is mind boggling. Right? In US, most of the mutual funds are still available at 2x the fees of India. So I don't really believe mutual funds are at threat, as a result of which I don't believe CAMS's business is at threat. Second thing, there is no supply side, right? Where is the competition? You have KFinTech, which has its own issues to deal with. They are coming out of it. But CAMS is a proxy monopoly or a proxy duopoly in the market leader. And there is a lot of room for them to grow, because these relationships are B2B relationships. They're extremely sticky. I'm not saying you're going to get 25% growth rate, right? That's not what I'm saying. I'm saying you're going to get steady 13 to 15% growth, right? So along with that, you're going to have significant operational leverage. along with the fact that there are some option based plays that people don't talk about today because you don't know how things are going to pan out, like how account aggregator takes shape in India, right? And that is a very, very nascent part of the ecosystem that we are in. So, and it has significant legs, and CAMS can be a significant player there as well. So, I still think you have a reasonable runway for growth, and I don't believe all of these so-called threats are real threats to the business of CAMS. Having said that, I think you, as an investor, you need to understand the expectations that I'm talking about. I'm not saying you're going to get 30% growth, right? That if that happens, that's more so luck rather than what you price in from a base case scenario. We as analysts price in a 13 to 15% CAGR growth, which at the top line, along with operational leverage, that could work out significantly, meaningfully on the bottom line. So that's how I think about CAMS.
The other thing is there's one more question along with subsequent question on that. But the growth of CAMS is not as high as the AUM growth. Any feedback on that?
Yes, it cannot be because end of the day, if you look at it, how the contracts are stuck, right? So an AMC will typically strike this kind of a contract with CAMS, right? They'll say at 5,000 crores. I'm just giving examples, okay? It's not this is not the contract that I have seen, but this is how it works. At 5,000 crores, I'll pay you maybe 10 basis points of my AUM for servicing me as a registrar. Once it crosses 20,000 crores, 10 will become 8. Once it crosses 50,000 crores, 8 will become 7. So your translation of an AUM scale up into a revenue scale up will be somewhere 75 to 80% approximately, right? So that is something that I think as an analyst you should be aware of. That's not a surprise, right? So having said that, do realize that when you talk about mutual fund growth, you are talking about this growth at least among 15 to 16 AMCs. I'm not talking about all the 50 AMCs. I'm just talking about that's where the lion's share is. Whereas when you translate that into a registrar, it is between two players. So your competition is also reduced drastically versus the mutual fund competition that exists.
The other thing is, Naveen, I keep getting this question from some of our investors that in case of PMS, the returns which is shown and the returns which is there in the paper actually has huge difference. So what is the reason behind it? Can you throw some more lights?
So the reason behind that is very simple, Vikas. The reason behind this has to go back to the genesis of the PMS industry, which pretty much runs on a model portfolio basis, right? So a model portfolio works in the sense I have certain set of stocks, I have certain set of exposures. If you come tomorrow, that's how the portfolio I replicate. So if I have a stock which is done well for me and its exposure has gone up, I keep buying the same stock at the higher valuation for my new set of investors, right? So which means initially I am going to create a drag, right? So that is historically how the industry works and has scaled. Now, is it right or wrong? That's not for me to comment. But all I know is we would not do that. We think it's suboptimal for investors, which is why I maintained to you in the presentation in the beginning that we don't run model portfolios, right? So, which is why if you don't run model portfolios, what does it mean? It means that you will take some time to deploy your capital, right? Which is what I keep telling. In many cases, we've taken up to 6 months to deploy capital. I have not been shy of maintaining cash at all because the third part of the presentation that I shared in our philosophy is do not overpay. So when the business is not available to me at the right price, I'm not going to ramp it up to our full exposure, which means I am going to maintain cash, right? So these are things that we do at ITIS. But if you're asking me why the industry returns are not what is represented in the fact sheet, it's unfortunately because of the way model portfolios are constructed.
So in your case, what return goes to SEBI when it is you are also authorized SEBI registered portfolio
So it
manager?
is the weighted average return of all our investors put together. So what that means is assume that I have had inflows in the last 5 months, okay, and I am maintaining 40% cash, okay, which means if I'm in a bull market, I will underperform. Yes, which means my weighted average return will also be less. So my older investors might have a reasonable upside because they are almost fully invested, but my newer investors will take some time to get fully invested. So the TWRR that we represent to SEBI takes care of all of this. So if there is a cash drag, then that has to get into the portfolio returns as well.
Okay, so essentially, I would say that it's going to be an average returns of all the investors put together.
Correct. It's the time weighted average return.
Time weighted average, yeah. All right, we'll move to next question. So, recently HDFC Bank, so we'll not take stock specific question much. Let's talk about the portfolios. Uh, so India has given birth to 22 unicorns last year. So do you think that this new age, yeah, so new age businesses which are coming up, what are your views on that, Naveen? Are you adding up anything in your portfolio or any feedback from your side?
So I think it's like so the question needs to be slightly more granular in nature, Vikas, because a new age portfolio to me means nothing, right? End of the day, all of the companies that are coming into the market, right, have shown phenomenal growth from a top line perspective. However, many of these businesses, the unit economics don't work, and or at least they are still not working. Many of these businesses are not cash flow generating. For us, whether it is new age or old age or semi industrial age, it doesn't matter. What matters is, can the business generate cash flows? And the value of a business is the present value of the future cash flows that the business generates. That's all we care about. It doesn't matter whether it is new age or old age, right? Having said that, in the last 9 months, there have been a whole host of IPOs that have come about, which is what you are talking about. And I think the only company the company that we have liked and we own is Nika, right? We don't own many of the other businesses that have IPO'd in the market. And that to us is a very different business than purely calling it a tech business. That's not the way we look at it, right? It's a very different problem that the business is solving and the opportunity that they're going after, where the unit economics at a single customer level is still profitable because of the high gross profit margins that they command. So for us, the way we look at any business is not whether new age means we have to value it differently and old age means we have to value it differently. It doesn't work that way, right? So as long as the business generates cash flows, we will look at it. Till it cannot, it's not sustainable for us to look at it.
Well said. So ultimately, in the long run, it is the corporate earnings, and stock appreciation mirrors the corporate earnings in the long run. And
Yeah, just a small thing. So earnings, many people in our country relate earnings to PAT, right? Because your earnings are a function of your PAT converted based on the total number of issuance of shares. I am talking about cash flows, right? So what that means is, just because you have 100 rupees of PAT doesn't mean you have 100 rupees of cash flows, because a lot of this PAT could be stuck in receivables, could be stuck in inventory. Your revenue accounting mechanisms could be flawed. You could have huge receivables. You could have huge depreciation. You could be financing this through debt in a significant way. So a lot of this needs to get accounted for to reverse and calculate what your actual cash flows are. That's what I am referring to rather than just earnings.
and also the redeployment of the cash which the organization generates.
Absolutely, yes. That's where the quality of the management and the promoter comes into question.
Correct. No, so I completely agree with you. I think it eventually what matters is the cash flow and how they redeploy either back into business or maybe they are building up something else. All right. I think there are no more questions. So I want to ask 2, 3 questions. So you would like to utilize the time because Naveen is here. So Naveen, how so you have had experience of running a large funds, So how has been the mentality? How they used to see India when you were abroad, and is there any change that you've noticed?
So I think India has always deserved a space in most FII portfolios. So I'm talking about 5-6 years back, right, before I came back to India. Whereas the space has been with respect to the fact that our demographics have always been important, right? We've always been relevant from a demographics perspective, not so much from an efficiency perspective. So I think the way I would summarize India always in the past has been the YouTube CEO mentioned this for 4 to 5 years back. He said, I look at China for my ARPU and I look at India for my MAU. What that means is I look at China for my average revenue per user, which is my monetization ability, but I look at India for my monthly average users, which basically means I'm not making money. I'm just looking for scale based on number of users. So that was how India and China was, right? So when you are looking at India purely from a demographics perspective, beyond the point, India will not be relevant in your portfolio. You might have a 5% exposure in India if you're a global investor, right? Today, that is slowly changing. That is slowly changing for three reasons. One, in US, you are potentially talking about a scenario where growth can slow down along with an interest rate regime that is going to go up, along with the fact that valuations are at a decadal high, right? In China, it's been great for capitalism until the last 3, 4, 5 years, where you had a host of both corporate governance issues and government coming in interfering with capitalism, which is never great, right? So you have great businesses in China available to you super cheap, but the cost of doing business in China has gone up in terms of what your expectation is. COVID, war, supply chain issues has resulted in, for the first time in 20 years, India actually becoming relevant from a global supply chain perspective. The simple analogy that I give is 5 years back, if you talk to the head of operations at Silicon Valley in Apple and you ask him, would he ever consider setting up a plant in India, he would laugh, right? Because the efficiency that he got in a Chinese factory is just mind boggling. Why come to India? Today, you have one of the largest manufacturing plants set up fully functional in Tamil Nadu, right? It's not a concept, it's run. iPhones are getting manufactured here. 5 years back, it was unheard of. So, from a supply chain perspective, India is no longer irrelevant. What that means is, from a capital allocation perspective, also India becomes significant. So, I think a lot has changed from what India was to global investors 5 years back to what India is going to become over the next 5 years. And obviously, retail investors have also become a dominant force in our country, right? And many people track SIP volumes, and because you are very well right in front of those volume trends, right? It's significant the kind of volumes that are coming through. So you have support not just from foreign investors today, domestic investors have become extremely relevant part of our ecosystem. So a lot has changed for India.
Sure, I remember I used to work for Motilal Oswal. By then, we used to organize various international activities and events, and these FIs when they used to come and attend the events. The only thing they used to say, "आपकी country में सब कुछ अच्छा है, but you guys don't take any major reforms." Now, at least their language has changed ever since the Modi government has taken over, and we see a lot of reforms coming in now. You look at GST numbers, look at the effect of demand, look at while we can debate on that, but there are many things that is coming up. Look at the PLI schemes, the way they are supporting various industries. So, I mean, it was very difficult for these companies to look at cost of capital now, which has come down substantially, and they are now able to generate goods which are as competitive as China used to be. So, I think in a way it's great. Next 5-10 years looks very great. Nevertheless, so couple of questions. So you said that you don't make model portfolio, you customize the portfolio. When I say you customize, as in you do it the way you want to deploy, is that the timing may change, right? So you may have a different stocks and you may take a cash call, or how is it?
So for us, so let's assume, I'll give you an example. Let's say we have a certain company, which we've been invested in for a while now, and it's done very well for us. The weight of the company has gone up to 13-14% today. Now, when new capital becomes available to us, that company will not be 14% anymore for a new investor. We might still like that company, but because of the risk reward and the fact of the valuation comfort, we might start off with only a 3% allocation. So that difference of 11% will automatically go into cash. Now we have two questions to answer. Are we going to invest that 11% back into the same company, or are we going to increase and upsize the position of another company? So as analysts, we are always working on new ideas, and if we find a new idea suitable, you will see us deploying the cash into the new idea. Or if this company goes through a correction, many people are talking about the IT correction today, right, which is not significant, but at least it is a beginning versus what you saw in the last 2 years. You might see some interesting opportunities come up there again, where we might increase our weights. So these are the two things that we would do as we look to redeploy over the course of the next few months. That's how we think about risk.
So it depends on markets levels, etc.
Yes, it purely depends. So the companies are kind of fixed, right? The question is the how you manage the exposures, because just stock picking is not the only job of a fund manager. Exposure sizing and position sizing is an even more important job of a fund manager, and that's something that very few people focus on.
Okay. And next question is: despite good credit growth and financial results, Bank Nifty and some of the banks have underperformed significantly last 6 months to 1 year. In fact, since 2020. So, what could be the possible reasons?
See, I mean, Bank Nifty, I don't know. Bank Nifty is a combination of private sector banks, PSUs, a whole host of things, right? In the last 1.5 years, you've had a reasonable, in fact, great rate of return from PSUs, which have done really well. Whereas your private sector banks, barring ICICI Bank, have struggled, right? So it's important to understand and realize banking is a cyclical business. Banking in India has always been sold as a structural business. It has never been a structural business because banking has its fortunes tied to the credit growth and the NPA cycle, right? So when you have a good, reasonable credit growth with a low NPA cycle, along with valuations in your favor, banks will do well, right? So what is the reason for an underperformance? Because today the market is rather playing companies which are beneficiaries of the direct capex rather than to play second order effects of credit growth from institutions which would lend to these companies for the capex, right? So I think you really want from here first capex to get deployed significantly, and then if the credit growth happens on the back of that and the net interest margins stay robust, banks would do reasonably okay. But having said that, you also need to pay attention to the valuations that you buy any of these banks at. So just because credit growth is happening, if you buy it at the wrong valuation, doesn't mean that you have to make money.
So, Naveen, when you say that you only look at cash component, which is the highest, cash generating machines, I would say. So, what if do you buy? So, out of these 20 companies, is this the one parameter which is very, very common, and without that, you will not move and buy any company?
So
Suppose my cash will be coming tomorrow, then
if a company cannot generate cash flows, then there is a fundamental flaw in the company, right? So, I mean, you cannot tell me that I continuously grow revenues, I continuously grow PAT, but I cannot show cash flows. What that means is such a company has to keep financing that working capital through debt. So that's what that means, right? So which means you are then buying debt heavy businesses. You could be buying great revenue growth, but you are buying debt heavy balance sheets. Would we want to be doing that? No. So for us, the reason cash flows matter is because that automatically lends itself into a stronger balance sheet. And you asked me a question: how did we withstand the downturn of COVID? Because each of our companies had very strong balance sheets through that. Such companies do better during bear markets.
so out of these 20 companies that you're saying, I mean, whatever 15, 18, 20, that's the way you construct the portfolio, you will eventually. So, do you find those companies in mid and small cap as well, and how would be the component, if I may ask you? Generally, the trend is.
So today, I mean, we still have a sizable exposure in mid and small caps, right? So our average market cap of our portfolio is around 47,000 crores today, right? Which means it's all at an average level, it is a midish cap portfolio. Our exposure between mid and small cap would be slightly close to, I would say, 64 to 65%, and around 25% in large caps across the board. So we still have a reasonably good exposure in mid and small caps. I mean, the example that we spoke about, CAMS, happens to be a small cap, but it's still a cash flow generating business, right? So when you are buying characteristics of a business which have pricing power, which where you don't have too much of competition, it lends itself into growth, which translates into cash flows. That's the nature of the kind of businesses you want to be buying.
So, Naveen, the other question is, generally when you are a small company and growing and becoming from micro cap to small cap and then migrating yourself to mid cap, obviously you need cash flow a lot to expand your business. And when you talk about cash flow, generally the large companies like HDFCs of the world or maybe Nestle's of the world will have higher cash generations at their board. But despite that, you maintain 65% on mid and small cap. So you're comfortable. Do you find those companies really generating cash in this universe?
So this is what I showed you, that slide, Vikas. Maybe I'll just go back to that slide quickly once again, because you asked
Sure,
a
please.
fairly relevant question, right? So you spoke about the large companies, correct? So the large companies, let's just use Nifty as a proxy for the large companies, right? The operating margin of large companies of Nifty, right, in the last 9 month FY22 is at 16.5%. In fact, 21 was at 14%. The operating margin of our portfolio is at 29%. What I'm trying to tell you is, just because you are large doesn't mean you have pricing power and the ability to generate cash flows. In fact, more than 65% of Nifty does not generate consistent cash flows. So, end of the day, just because you have a large business, if you are operating in a sector that is cyclical in nature, which has a lot of competition, inherently that means that your ability to generate cash flows will always be limited, and it will be cyclical in nature. So large always does not mean good and large always does not mean safe. And many of the mid and small cap companies that we own, if you look at it and break it down, they would either be the market leader or among the top two businesses that operate in that sector. So rather than calling it large and small, what I would always like to use as a reference is, what is the competitive landscape of the company that you own, and what is the market share growth of the company that you are owning. If these two are not expanding, you will not generate returns. It's as simple as that.
All right, so there are no more questions. So I can see some stock specific questions which I am ignoring purposefully. So one disclaimer here, whatever stocks that we've discussed, please do not go and invest. Please talk to your financial advisors or maybe the portfolio manager before you invest in those stocks. So thank you so much, Naveen, for taking the time out from your busy schedule and joining it. It was
Thanks
pleasure
a lot.
interacting with you. A lot of things to learn, and great that we wish you all the very best for your endeavor, and you're doing a fantastic job. Keep it up. Thank you so much, and my regards to your entire team.
Thanks a lot, Vikas. Sincerely appreciate you having us on the platform. And thanks to your audience as well for sparing the time to come onto the platform. Appreciate this.
Thank you. So thank you everyone. In case you have any question for Naveen, please write to me at vikas@aifpms.com. I'll ensure that I'll talk to him and get them answered. So once again, thank you so much everyone for joining in. Thank you.